Hello, everyone. Thank you again for joining us for today's session. Sorry for a slight delay. I welcome you to today's session on central bank digital currencies. Is this the future of money? I am Shahnaz Ahmed. I am a senior resident fellow and the fintech lead at the Vidhi Center for Legal Policy. Now, at Vidhi, when we first started our work on central bank digital currencies, it took us back to the fundamental question of what is money. Now, throughout history, we have seen physical tokens being used as money, with the recent manifestations being banknotes and coins. In most cases, these physical tokens do not really have an intrinsic value in itself, but people accept them as a means of payment with the hope and expectation and trust that they will be used by others. So the banknotes and physical tokens essentially derive their value from a common imagination or the collective agreement that we as a society have come to. Now, today, when a farmer sells perhaps his harvest in the market for a few banknotes, in exchange of a few banknotes, he knows perhaps that these banknotes may not really have any intrinsic value. But what he does know and trust is the fact that there will be others in the society who will be willing to sell goods and services to him in exchange of those banknotes. So perhaps what I'm trying to say here is that money is essentially based on a system of mutual trust. And history has shown us that money as a convention needs to be backed up by some sort of an institutional arrangement, which perhaps is best provided by an independent central bank. Now, over the couple of last years, questions have started to emerge in terms of how technological innovations will impact money and the payment systems. To a certain extent, digital money itself is not a new concept. I mean, we are all aware about commercial bank deposits being available digitally and being used for digital payments. Central bank money to a certain extent is digitally available for banks and financial institutions which hold accounts with the central bank. However, the latest innovations involve new forms of digital money. But rather than using commercial bank money as the basis for transactions, providers of new forms of digital money are innovating and trying to understand if they could use their own and issue their own money. Perhaps developments around stable coins have intensified these discussions. Now, central banks are not left behind. Central banks across several economies are in fact exploring the possible use case or possible issuance of a digital version of their fiat currency or national currency, which is now popularly referred to as central bank digital currency. Now, each of these developments that I have talked about right now has raised some very important questions about the basic architecture of money and its impact on the financial system. Now, to discuss these developments with me and to understand the future of money and its impact on the financial system and the monetary system, we have with us a stellar lineup of speakers. We will start firstly with the keynote address by Mr. Rabi Sankar, Deputy Governor of the Reserve Bank of India. This will be followed by a panel discussion with Mr. Sugato Bhattacharya, Executive Vice President and Chief Economist at Axis Bank, and Mr. Ashraf Khan, Senior Financial Sector Expert at the International Monetary Fund, and I'll be the moderator for the session. So without further ado, let me invite Mr. Rabi Sankar to please deliver the keynote address for today. Over to you, sir. Mr. Sankar, you're on mute.
Can you hear me now?
Yes, we can.
Thank you. Just a small clarification. How much time have you allotted me?
No, you can please go ahead with it. There's no such, it's up to you. We'll be waiting to hear you.
No, great, thanks. What I propose to do today, I think you have given a very neat introduction about the nature of money, which is important because a lot of discussions happen today without a very clear definition, which is commonly understood across debaters, across participants, about what exactly is money, what exactly is currency, and what exactly is a central bank digital currency or a private virtual currency. I was thinking, I thought it would be a good idea to dwell a little bit on that to convey what I think is a currency or is a CBDC or is a virtual currency. But more importantly, to initiate better debate and therefore better awareness and better learning for all of us, about the nature of these innovations that are happening, whether CBDC or private currencies. I just wanted to clarify up front that in some places I have expressed my views, for example, on the nature of evolution of money, etc. Those are my personal views. They're not the Reserve Bank's views. So we would discuss that. Then I would go into some specific aspects that are important from the point of view of a CBDC. Essentially, that how does it interplay with the banking system? How does it interplay with monetary policy? How does it interplay with currency and other systems that we have? We would discuss. I would like to discuss that briefly, and end with generally what the Reserve Bank has been doing or what its thinking is in this respect. So, having said that, I think let me just start off. Probably I won't do justice to the subject itself. Is it the future of money? I have no idea. But is it one form of money that we are likely to see more of in the future? Definitely. Given the sudden increase in interest by central banks and other bodies across the globe. Okay. Just by way of an introduction, the idea of central bank digital currencies may not really be a recent development. Some actually attribute the origins to James Tobin, a Nobel-winning economist, American economist, who in the 1980s, suggested that the Federal Reserve banks in the United States could make available to the public a widely accessible medium with the convenience of deposits and the safety of a currency. So we have the roots of what could be a central bank digital currency there. Yet, it's only in the last decade that the concept of digital currency has been widely discussed by central banks, economists, and governments, apart from private participants, especially in the technology sector. Now, except as currency notes, this is the state of financial system that we have. Except for currency notes, all other uses of paper in the modern financial system, be it be bonds, securities, transaction contracts, communications, confirmations, etc., correspondence, messaging, everything has been replaced from paper, to digital and electronic versions. People have told me, bankers who have traded earlier were telling me how they would come with, when they do bond trades, they come with those SGL forms, filling up the details, queue up in front of the Reserve Bank of India and settle those trades. Now, those things have gone pretty much, whether it's in the equity market or bond market or even in other markets. Except that currency has largely remained in its physical form. It's, generally paper, but could also be, other versions like polymer, etc. On anecdotal evidence, use of physical cash in transactions too has been declining in recent years. And this trend has been reinforced somewhat by the COVID-19 pandemic that we have had in the last year and a half. Now, these developments have resulted in many central banks and governments stepping up efforts towards exploring a digital version of a currency. Some of this interest among central banks has been indigenous in nature for pursuing specific policy objectives. For example, facilitate negative interest rates, in Europe and so on, so some advanced economies. Central banks have been looking at this as one way of ensuring negative interest rates on currency. Another driver could be to provide the public with virtual currencies that carry the legitimate benefits of private virtual currencies, which are clearly, increasingly being used, while avoiding any possible damaging economic consequences such as volatility that private currencies might have. But to go forward on this, as I said, we need to understand what is a CBDC. It's important to understand and appreciate what precisely is a CBDC And to do that, as I said, one needs to understand what a currency is and what money is. What is currency? Let's start with money. As societies developed from hunters and gatherers, material needs increased to build a house, wear clothes, make weapons and implements. Since these needs could not be produced individually by the same person, people had to trade. They had to purchase things from one another. This purchase was paid initially by barter. Leather skins, cloak for a spear, for example. As barter had its limits, you had to transport the goods and access becomes a big constraint and so on. Barter got standardized gradually with the evolution of time. It got standardized in terms of metals and cowrie shells. Now, initially, now people knew the value of both the cloak and the spear in terms of the value of the bronze or the cowrie shells. I think there is somewhat of a misunderstanding that when we use these bronze and cowrie shells, they were representative forms of money, but they were actually commodities which had intrinsic value. The value of the bronze that was being paid to purchase, purchase a weapon or whatever. Shells, similarly, were desired for their beauty. So they did have intrinsic value, aesthetic value, perhaps not material value. Now, this system evolved over time into metal currencies. Gold and silver coinage were the offshoot of this system. Eventually, this is where they settled down. But even here, the intrinsic value of gold and the intrinsic value of the, of the commodity that is being purchased or sold with this gold had to be similar. So, in a sense, this is a hybrid of a gold, using gold coins or silver coins is actually a barter in that sense. But since they were standardized, you can look at them as hybrids of barter as well as representative money. Now, somewhere along the way, people improvised. Instead of actual goods for barter, they started using claims on goods, claims on commodities, a bill of exchange, in fact. These could be clay tablets in Mesopotamia, which represented what was stored in a certain silo, what goods were sold, or they could be, paper currency as it happened in China in the 11th century. In fact, China started off, I think, pretty much in the 7th century with something similar to bills of exchange as well. So two facts emerge very clearly from this historical development. One, money has taken the form of either commodities that have intrinsic value or in terms of debt instruments. This is important to understand. When money does not have intrinsic value, it has to represent title to commodities that have intrinsic value or title to other debt instruments. Paper currency is such a representative money, and it is essentially, you can look at it as a debt instrument. The owner of the currency knows who owes him or who has the underlying liability. So if you're looking at the rupee currency note, if I am holding it, I know that Reserve Bank owes me money. What that means is, of course, something else. But the statement that I promise to pay the bearer is in a sense an acknowledgement of debt. Can you just give me a minute? Please give me just 1 second. My apologies. Okay, so the owner of the currency knows who owes him and who has the underlying liability. In other words, there is always, I emphasize the word, there is always an issuer of representative money. Whether it is the government, which has what has happened, with evolution in the last 150 years, or whether it's a private bank issuing it or a trader issuing it like Italian banks, in the 15th, the 16th centuries, one always knew who the issuer of that currency is. This is important to keep in mind, whose liability it is. The second point that emerges is that money is usually issued by a sovereign. Even when gold coins were issued, they were issued by kings, largely by kings or rulers. Private issuance of money, whether under sovereign license or otherwise, has existed in the past, but has over time given way to sovereign issuance for two reasons. Firstly, being a debt issuance, if you don't look at it as a commodity, with intrinsic value, you can look at it, as we said, as a debt instrument. Firstly, being a debt instrument, private money is as good as the credit of the issuer. So whether this makes private currencies unstable. This and the fact that there would be multiple issuers. It wouldn't be just one Italian banker or businessman who is issuing it. There would be 10 or 12 that would be issuing it. There would be multiple ones, and there would be a credit risk. Both of these add to some degree of volatility or some degree of uncertainty in the nature of a currency. On the other hand, public currency, as it is backed by sovereigns, is unique. There is only one to an economy and has better credit standing. It has the best credit standing in that currency because the issuing authority can simply print and issue. Therefore, it is far more stable, and that is what has evolved over time. Secondly, paper currency involves seigniorage. When you use representative currency, there is a difference in value between the intrinsic value of that paper currency and the value that it represents. And that intrinsic value, in a broad sense, accrues to the issuer, to the sovereign usually. This seigniorage ideally should not accrue to any private individual. It should accrue to the government and thus used for public spending. So there are two issues that come out when money is being issued by a sovereign. One is that sovereign issuance is more stable. Two, sovereign issuance ensures that seigniorage doesn't accrue to private entities or individuals. Both of them are socially more desirable outcomes. Now we are in a position where, having gone through this brief introduction, we are in a position to provide a definition of currency. In modern economies, currency is a form of money that is issued exclusively by the sovereign or a central bank as its representative. It is a liability of the issuing central bank and sovereign, and an asset of the holding public. Currency is fiat, it is legal tender. Currency is usually issued in paper or polymer form, but the form of currency is not its defining characteristic. So that brings us to how would we go about defining a central bank digital currency. Now, a central bank digital currency can now be defined as the legal tender issued by a central bank in a digital form. What is being issued in paper form is now being issued in a digital form. It is the same as fiat currency and is exchangeable one-to-one with fiat currency. That is how I would define a central bank digital currency. There are variations. There are different uses from the point of view of which these definitions could differ. But fundamentally, I'm looking at central bank digital currencies as substantially no different from its paper currency. Only its form is different. Now, a couple of points follow. It is important to understand what a CBDC is not. We have defined it as basically the currency, sovereign currency that is being issued in a digital form. Now we need to understand what it is not. CBDC is a digital or virtual currency, but it is not comparable to private virtual currencies that have mushroomed over the past decade or so. Private virtual currencies particularly sit at substantial odds to the historical concept of money. They are not commodities or claims on commodities, as they have no intrinsic value. Some claims that they're akin to gold seems to be opportunistic because gold has intrinsic value, at the end of the day. Usually, certainly for the most popular private currencies that are there, they do not represent any person's debt or liabilities. In other words, there is no issuer of a private virtual currency. Now, they are not money in the way that we have defined money, as money has been understood historically, that it either has to be a commodity or it has to be a title to a commodity, or it has to have an issuer like a debt instrument. So from those points of view, these private currencies Many of them, there are many varieties, but certainly the more popular ones of them, as they do not have an issuer, they have no intrinsic value, they do not fall under the definition of a currency, as we have defined it. A line of argument that has helped private currencies somewhat to gain the status of a currency is the argument is that that most money in modern societies is in fact already private, since they represent deposit liabilities of private banks. Now, this is an argument that I've read in the speeches, etc., of certain central banks, very prominent central bankers as well. I think there are 2 points that such a line of argument is not really taking into consideration. One, deposits are issued by banks under license of the sovereign issuer of currency, usually the central bank. 2, deposits are accepted by the public, although this is not something that is explicit, but they are accepted because they are convertible one-to-one into sovereign currency. So a simple way to understand, I'm not saying it is legally and substantively this, a simple way to understand currency and deposit money is to look at deposits as lending of sovereign currency by the depositor to the bank for payment of interest, if it's an interest-paying deposit. Credit, its opposite side, is lending of sovereign currency. You can look at that as lending of sovereign currency by banks to the public on interest. Okay, so they cancel out on the balance. They are the ones which create the balance sheet. Bank deposits are money. Let's have no doubt about that. Bank deposits are money, certainly, but they have no independence existence as money, or more specifically currency. They are not an independent currency shown of sovereign authority and the resultant public confidence. So in any case, quite apart from we have dwelt at some length, because the statement that money, private money is already being used, is being used too lightly, I believe, in the discourse these days. I think that point has to be kept in mind. In any case, bank deposits are very different from a private currency, because bank deposits have an issuer, the bank. Private currencies don't. And bank deposits are convertible one-to-one with sovereign currencies. Private currencies are not. Okay. To sum up, CBDC is the same as currency issued by a central bank, but takes a different form, a digital form. It is sovereign currency in a digital form and would appear as liability, just like paper currency would on a central bank's balance sheet. The underlying technology, form, and use of CBDCs can be molded for specific requirements, but CBDCs would essentially have to be exchangeable at par with cash. So that is, that is what I thought it would be useful to understand how money has evolved, what exactly are the defining characteristics of money, and whether the various competitors measure up to those characteristics. Now let us go to the next question, that why is a CBDC required? What is the need of a CBDC in general? While interest in CBDCs now is nearly universal, very few countries have actually reached even the pilot stage in launching their CBDCs. 2021 BIS, Bank for International Settlements in Switzerland, Basel, BIS survey of central banks found that 86% of central banks were actively researching the potential of CBDCs. 60% were experimenting with the technology, and 14% were deploying pilot projects. Why this sudden interest? Most of it has happened in the last couple of years. So why this sudden interest? The adoption of CBDC has been justified for the following reasons. One, some central banks, faced with the dwindling usage of cash or paper currency, for example, Sweden, seek to popularize a more acceptable electronic form of the sovereign currency. there could be a fear that, I was listening to some, some talk from a Swedish official, and she was saying that, if this trend continues, then there probably would not be any, any Swedish krona available because no one would be using it. The idea is to keep that alive by issuing it in a digital form, hoping that it would be more acceptable. That's one. On the other extreme, you have jurisdictions with significant physical cash usage seeking to make cash use more efficient. India could be one of them, but there are other countries. Germany has a very high cash usage and so on. The idea there is, since there is a general preference for currency notes and they are in the form of cash, it would probably be more efficient to issue them in a digital form and reduced over dependence on cash. So give them currency with all its features, but only in a different form. The third is basically, this is something that has been not been exactly spelled out by any central bank, but this is something that is there as a general idea in the debate that is going on globally now, that central banks seek to meet the public's need for digital currencies, manifested in the increasing use or discussion about private virtual currencies. And thereby provide a sovereign version of a virtual currency and try to minimize any damaging consequences of such private currencies. This could be another reason why central banks are, looking at developing their own CBDCs. In addition to these three, broader arguments of why central banks might go for digital currencies, CBDCs have some very clear advantages over other digital payment systems. Payments using CBDCs are final and thus reduce settlement risk in the financial system. Imagine a UPI system. Most of you would be familiar with the UPI system. It's real time. Everything is fine. What you don't realize is that the transaction isn't settled. There is, there is a background settlement that happens between banks in the books of the Reserve Bank of India. Only then are the transactions final. So imagine a UPI system where CBDC is transacted instead of bank balances. Today it is between bank balances. Where CBDC is transacted instead of bank balances, and as if cash is handed over, the need for interbank settlement disappears because it is final. It is central bank liability being handed over from one person to another. CBDCs would also potentially enable a more real-time and cheaper globalization of payment systems. It is conceivable for an Indian importer to pay, let's say, its American exporter on a real-time basis in digital dollars without the need of an intermediary, as long as both the digital systems are connected. This transaction would be final, which means, as if cash dollars are handed over, which means that one would not even require that the US Federal Reserve settlement system is actually open at that point in time. Okay, those of you who understand risk in foreign exchange transactions would appreciate this. The time zone difference in currency transactions would virtually disappear. What is called Hurstad risk would no longer exist if you can actually transact in digital currencies between two countries, both of whom have this digital currency. So these are some of the benefits. There are many. There could be many other benefits, but these are some of the very clear benefits that spring to mind for which justify why CBDCs would be required. We come to the next question that yes, they are required. Would they be required in India? Do we think CBDCs are required in India? Now we have discussed these advantages. Those advantages are advantages that could also accrue to us in India if CBDCs were issued. Although for the benefits to global settlements to accrue, it is important that both the countries in a currency transactions have CBDCs. In fact, this is one thing that has been highlighted by BIS, by Christine Lagarde, that it is important that all central banks get on the CBDC arrangements and coordinate effectively with themselves to actually maximize the immense potentials that CBDCs carry. Okay. Now, anyway, coming to India-specific factors, India is leading the world in terms of digital payment transactions, innovative digital payments transactions. Its payment systems are available 24/7. They are pretty much real time for both retail and wholesale customers. The cost of these transactions is perhaps some of the lowest in the world, if not the lowest. Users have an impressive menu of options to undertake any particular transactions. And digital payments, because of all these factors, are growing at a staggering, CAGR cumulative average growth rate of 55% over the last 5 years. It would be actually difficult to find another payment system or another country with a payment system like UPI that even allows the transaction for 1 rupee. With such an impressive progress of digitization, is there a case for CBDCs? In other words, what is the need that CBDC addresses that these payment systems cannot address? A pilot survey conducted by the Reserve Bank on retail payment habits of individuals in 6 cities between 2018 and December 2018 and January 2019, results of which were published in the April 2021 RBI bulletin, indicates that cash remains the preferred mode of payment and for receiving money for regular expenses. For small value transactions, usually up to 500, cash is actually used predominantly, even today, or rather, 1819 when the survey was done. There is thus a unique scenario of increased proliferation of digital payments in the country, coupled with sustained interest in cash usage, especially for small value transactions. To the extent the preference for cash represents a discomfort for digital mode of payment, CBDC is unlikely to replace such usage. But preference for cash for its anonymity and other significant factors that account for the demand for paper currency, such preference can be redirected to acceptance of CBDCs, as long as anonymity is assured. Now, India's high currency to GDP ratio, India has a fairly high currency to GDP ratio. High currency to GDP ratio holds out another benefit of CBDCs. To the extent large cash usage can be replaced by CBDCs, the cost of printing, transporting, storing, and distributing paper currency and coins can be substantially reduced. The cost of the currency system could be substantially reduced. The other one we have already agreed, the advent of private virtual currencies is another reason why it might become necessary. It is not clear what specific need is met by these private virtual currencies that official money cannot meet. In fact, this is one of the arguments made by another Nobel-winning economist, Paul Krugman. That is not clear, but that may in itself not come in the way of adoption or popularity of these private currencies. If these private currencies, virtual currencies, gain recognition, national currencies with limited convertibility are likely to come under some sort of a threat. To be sure, freely convertible currencies like the US dollar may not be affected at all, or significantly, as most of these virtual currencies in any case are transacted and denominated in terms of, for example, the US dollar. In fact, these VCs might actually encourage the use of US dollar, as has been argued by Randall Qualls recently in a speech. Developing our, I would put this speech in the public domain. We would provide the necessary references. So if I'm saying anything here for which you don't have a reference, it can be accessed. We'll try and put it up today, so you should be able to access it quickly if you desire. Developing our own CBDC could provide the public with uses that any private VC can provide, and to that extent might return public preference for the rupee. It could also protect the public from the frightening level of volatility some of these virtual currencies experience. Indeed, this could be the key factor nudging central banks from considering CBDCs as a secure and stable form of digital money, for which there clearly is interest, if not demand. I was talking about Christine Lagarde. This is what she has to say. The central banks have a duty to safeguard people's trust in our money. Central banks must complement their domestic efforts with close cooperation to guide the exploration of central bank digital currencies, to identify reliable principles and encourage innovation. I'm quoting her. The case for CBDCs for emerging economies is thus fairly clear. CBDCs are desirable not just for the benefits they create in the payment systems, but also might be necessary to protect the general public in an environment of multiple, some of them very volatile, private virtual currencies. Now, having established, presumably the reasons why we should, especially as an emerging economy with not an entirely freely floating currency, I think now we need to look at, if we have to introduce it, what could be the possible issues that we need to grapple with. I will just focus on some of the more important ones. One is CBDC and the banking system. Now, CBDCs, depending on the extent of their use, can cause us reduction in the transaction demand for bank deposits. That's fairly clear. Since transactions in CBDCs reduce settlement risk as well, we have discussed that, they reduce the liquidity needs for settlement of transactions. For example, intraday liquidity on RTGS. In addition, by providing a genuinely risk-free alternative to bank deposits, they could cause a shift away from bank deposits, which in turn might reduce the need for government guarantees on deposits. This is something that has been argued in some academic papers. At the same time, and these are some of the benefits that could accrue, at the same time, reduced intermediation of banks carries its own risks. If banks begin to lose deposits over time, their ability for credit creation gets constrained. Since central banks cannot provide credit to the private sector, the impact on the role of bank credit needs to be very well understood before these instruments are issued. Plus, as banks lose significant volume of low-cost transaction deposits, their interest margins might come under stress, leading to an increase eventually in the cost of credit. Thus, potential costs of disintermediation mean it is important to design and implement CBDC in a way that makes the demand for CBDC vis-a-vis bank deposits more manageable for the system. Even if it is difficult to a priori understand how public behavior might change, it is important for policymakers to ensure that such change happens at a rate slow enough for the system to adapt efficiently. There is another risk of CBDCs that could be material. Availability of CBDC makes it easy for depositors to withdraw balances in case a bank comes under stress. Flight of deposits can be much faster compared to withdrawal of currency notes. On the other hand, this is something that could happen. If a bank comes under pressure, money could flow out very quickly from the bank. But on the other hand, just the availability of CBDCs might reduce panic, because depositors have knowledge that if required, they can actually withdraw very quickly. Okay, so one consequence could be that banks would be motivated, given this risk, banks would be motivated to hold a larger level of liquidity, which could again result in slightly lower returns for commercial banks. Now, these are some of the risks and returns of for the commercial banking system. In actual fact, notwithstanding the benefits of CBDCs vis-a-vis bank deposits, since CBDCs are currency and therefore do not pay interest, their impact on bank deposits actually might be rather limited. Depositors that require CBDCs for transactional purposes, in all probability, will enter into arrangements where the unused currency is swept into bank deposits at the end of the day. So if that actually happens, then banks may actually not end up losing, as much deposits as it could be feared. Secondly, CBDC and monetary policy. What impact it will have, because it's a new form of money. We do not really know how behavior will change of economic agents. So what impact it might have on monetary policy. That is not actually very clear. CBDC may bring about a change in the behavior, and what that behavior we of course don't know. But if there is an overwhelming demand for CBDC, and CBDCs are issued largely through the banking system, which is the likely scenario, more liquidity may need to be injected to offset the currency leakage from the banking system. Okay, so banks would probably, the demand for central bank liquidity from banks would probably go up if the use of CBDC goes up. This is one thing that could affect how monetary policy transmits. Much recent discussion has focused on the use of negative interest-bearing CBDCs for effectiveness of monetary policy for a specific reason. The extremely low inflationary environment in Europe or Japan or some similar advanced economies has constrained their ability to reduce interest rates beyond zero, below zero, because any reduction in interest rate on bank deposits there would drive deposits away to cash. So that would have consequences that would be difficult to manage. However, monetary transmission of negative policy rates to boost demand could be more effective if currency itself can carry a negative interest rate. So if you, instead of paper currency, if you have digital currency and you could program those currencies to carry a negative interest rate, then the move away from bank deposits to CBDC to currency will not happen. And to the extent it does not happen, sub-zero interest rates, negative interest rates can actually be used as an important policy tool by central banks if required. That is something, especially from these advanced economy central banks, that is one of the drivers for CBDC. But such steps may be taken with care, as again, in my view, any instrument that pays interest, positive or negative, is strictly not a currency. To the best of my ability and my understanding, currency has never paid interest. In fact, not paying interest is what, because it is perfectly liquid, not paying interest is what distinguishes currency from non-currency financial assets. Anyway, the third point is, of course, the next point is CBDC and technology risk. Most of you would understand that CBDC ecosystems may be at similar risk for cyber attacks as payment systems are exposed to these days. Further, in countries with low financial literacy levels, the increase in digital payment related frauds might also percolate to CBDCs. Ensuring high standards of cybersecurity and parallel efforts for financial literacy is therefore essentially for any country dealing in CBDCs or thinking of introducing CBDCs in a big way. Absorption of CBDCs in an economy is also subject to technology preparedness. The creation of population scale digital currency system is contingent upon the availability of high-speed internet and telecommunications networks, and ensuring the wider reach of appropriate technology among the general public, or at least come up with use cases which can work offline, which can work on feature phones and so on, even for these currencies. So technology has to evolve simultaneously. In countries with lower level of technology, adoption of CBDC to that extent might actually be limited. Now, I will very briefly talk about RBI's approach to CBDC. Now, central banks across the globe are engaged in exploring CBDCs, and a few countries have also introduced proofs of concept, as we said, and pilots on CBDCs. In India, the high-level interministerial committee, constituted in the Ministry of Finance, has examined the policy and legal framework and has recommended the introduction of CBDC as a digital form of fiat money in India. Like other central banks, RBI has also been exploring the pros and cons of introduction of CBDC since quite some time. Generally, countries have implemented specific purpose CBDCs in the wholesale and or considering implementation of specific purpose liquidities, CBDCs in the wholesale and retail segments. Going forward, after studying the impact of these models, launch of a general purpose CBDC, which is population scale, can be considered. RBI is currently working towards a phased implementation strategy and examining use cases which could be implemented with little or no disruption. I'm referring to the impact that it could have on the banking system and the impact that it could have on monetary policy. The idea is to start off with, with models that would have minimal such impact and no impact if it can be helped. Some key issues that are being examined are the scope of CBDCs, whether they should be used in retail payments or should they be used in wholesale payments. The underlying technology, whether it should be a distributed ledger or a centralized ledger, or whether different use cases can use either of these two to be more efficient. The validation mechanism, whether it should be token-based or account-based. The distribution architecture, whether it will be issued directly from RBI or through the banking system, degree of anonymity, etc. These are some of the issues that we are looking at very closely now and studying them. However, conducting pilots in wholesale and retail segments may be a possibility in the near future. So some progress has been made. We could likely come out with this in the near future. This is, Vidhi is a legal entity, so there's not much that I need to tell regarding the legal framework, but we have also had a look at that internally. But although CBDCs are conceptually no different from banknotes, introduction of CBDC would require an enabling legal framework, since the current legal provisions are made keeping in mind currency in a paper physical form. Under the Reserve Bank of India Act, the bank is empowered to regulate the issue of banknotes in the preamble itself, and the Reserve Bank derives the necessary statutory powers from various provisions of the Act with respect to denomination from Section 24, with respect to the form of banknotes from Section 25, or the status of legal tender in Section 26, etc. There is a need to examine, if CBDC has to be introduced, some sort of an amendment to these provisions is required. There is a need to also examine consequential amendments to the Coinage Act, to FEMA, and of course the Information Technology Act. These are some of the things that we are looking at internally. Even though CBDCs will be a primarily technology-driven product, it will be desirable to keep the legislation technology neutral, to enable coverage of a wide variety of technology choices. That's pretty much it. I would now just conclude with a few remarks. Introduction of CBDC has the potential to provide significant benefits, such as reduced dependence on cash, higher seigniorage due to low transaction costs, or even probably higher use of currency in digital form, reduced settlement risk, and so on. Introduction of CBDCs would possibly lead to a more robust, efficient, trusted, regulated, and legal tender-based payment system. There are associated risks, as we have discussed, but they need to be carefully evaluated against the potential benefits. It would be RBI's endeavor as we move forward in the direction of India's CBDC to take the necessary steps which would reiterate the leadership position of India in the payment systems environment. CBDCs are likely to be in the arsenal of most, if not every central bank going forward. Setting this up will require careful calibration and a nuanced approach to implementation. Drawing board consideration and stakeholder consultations are important. As far as we are concerned, they're either happening or will happen going forward. Technology challenges have their importance as well. As they say, every idea will have to wait for its time perhaps the idea for CBDCs is near. Thank you. I'll stop here.